Hi, I'm Audie. In today's video, we will decode the high-stakes data that moves global markets before you even finish your morning coffee. Using the latest reports from the Bureau of Labor Statistics for February and March 2026, we are going to look at how money moves through the economy and what it means for your wallet. Think of this as your cheat sheet for understanding why things cost what they do and where those prices are headed next. Inflation is essentially measured at two different ends of the same economic street. On one side, we have the Producer Price Index, PPI, or the factory gate price, which tracks how much producers actually receive for their goods and services. On the other side is the Consumer Price Index, CPI, or the checkout counter price, which is what you and I pay at the register. Because the PPI is published by the BLS about a week before the CPI, it acts as a crucial early warning signal for what's coming to the stores. The Consumer Price Index isn't just one number. It's a carefully weighted basket of everything we spend money on. If you look at the breakdown, shelter is the absolute heavyweight, making up 36.2% of the basket, which means rent and housing costs drive the headline inflation number more than any other single item. The rest is filled with transportation, 16.1%, food, 13.6%, medical care, 6.5%, and energy, 7.1%. To get this data, BLS staff physically visit roughly 94,000 locations across 87 U.S. cities every single month to keep the numbers accurate. To understand the Producer Price Index, you have to look at the industrial supply chain in 3 stages. Stage 1 involves raw, unprocessed materials like crude oil or wheat. These are the most volatile and take the first hit when global supplies get disrupted. Stage 2 covers intermediate goods, like flour or steel beams. Finally, Stage 3 is final demand, or products like a loaf of bread that are closest to what consumers see. Usually, businesses will try to absorb Stage 1 and 2 costs themselves at first, but eventually they have to pass those costs down the line to the consumer. The relationship between these two numbers is simple. PPI today equals CPI tomorrow. The PPI is a leading indicator, acting as an early warning system because factory costs always spike before retail prices do. The CPI is a lagging indicator because it reflects the current reality already hitting your wallet. Typically, there is a 1 to 3 month lag between a spike at the factory and a spike at the store, as it takes time for products to move through the pipeline. The data from February 2026 reveals that pressure is building rapidly at the factory gate. While the CPI was 2.4%, which was exactly what experts predicted, the PPI came in hot at 3.4%, smashing the forecast of 2.9% and marking its highest point in over a year. We also look at core numbers, which strip out volatile food and energy prices to show the calmer, structural trends that the Federal Reserve uses to decide on interest rate policies. Behind the big percentages, individual categories are swinging wildly month over month. For consumers, there was a bit of relief as used car and truck prices dropped by 3.2%. However, at the producer level, things look much more intense. Fresh vegetables skyrocketed by 48.9%, and financial services jumped by 4.2%. Even though your car might be cheaper, the cost of the food on your table and the services you use are facing massive upward pressure. Analysts use a diagnostic dashboard with 4 dials to read these reports. First, the headline versus core gap is tiny 2.4% versus 2.5%, meaning inflation is now broad and not just caused by one specific oil or food shock. Second, while the yearly numbers look stable, the month-over-month MOM increase of 0.3% shows that short-term pressure is actually accelerating. Third, the 1 percentage point gap between PPI 3.4% and CPI 2.4% is a major warning for future prices. Finally, Services inflation remains sticky, which is the Fed's biggest headache to solve. Context is everything, and February's numbers might already be outdated due to external shocks. History shows that a 1 percentage point gap between PPI and CPI usually predicts a sharp consumer price hike within 90 days. Furthermore, we have a data blind spot because the October 2025 government shutdown prevented the BLS from collecting data. Moody's estimates the true CPI is actually about 0.3% higher than reported. On top of that, a war involving Iran started after this data was collected, and gasoline prices have already jumped 19% in just 2 weeks, which will hit the March CPI numbers very hard. When these reports are released at 8:30 a.m., they trigger an immediate earthquake in the markets. Following the hot PPI report, the U.S. dollar strengthened because investors realized interest rate cuts would be delayed. Indeed, the Federal Reserve held rates steady at their March 18th meeting, and bond traders have now pushed the expectation for the next rate cut all the way to December 2026. This affects everything from the S&P 500 futures, which fell, to your personal wallet, as these numbers eventually trigger Social Security cost of living adjustments. To sum it all up, PPI is for producers, CPI is for consumers. PPI is your leading indicator that predicts the future, while CPI shows the reality of today. Remember the golden rule? PPI today equals CPI tomorrow. Keeping an eye on what factories are charging is the best way to know what you'll be paying at the checkout counter in a few months. Just remember, trading involves risk and aren't for everyone, so treat this as an educational guide for your financial journey. Investing in options trading involves significant risk and are not suitable for all investors. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.